Let's now move on to Article 13, capital gains. And this one actually has been the one which is being used and also being abused by a large number of people, because certain treaties that India has entered into provides for capital gains exemption to certain residents who are residents of countries like Mauritius, Singapore, etc. While these provisions are undergoing changes currently, but in the past, many people have used this particular article to take exemption on capital gains which may not genuinely had been available to them. Now, while the heading of the term is capital gains, in most of the article, if you actually see the entire text, it talks about gains and not capital gains. But that should not make too much of a difference in terms of our conclusion, because the underlying subject in most of these cases is a capital asset. So, what could be the potential situations where a capital gain may arise? Broadly, there could be two situations. There's a transfer of shares by non-resident to a resident. Now, I've used the word shares here, right? Because this is the most common thing which is understood in the context of capital gains. But this actually applies to all the assets which are covered under capital gains. So let's say there is a foreign company which is based out of Netherlands. This foreign company owns shares of an Indian company, ICO 1. It transferred the shares of this Indian company 1 to another Indian company, ICO 2. In such a case, there is a transfer of shares which is a capital asset, right? The gains or loss, as the case may be, shall depend on the provision of Article 13 relating to capital gains, right? So in this case, you had a transfer from a non-resident to a resident of shares of an Indian company. Another situation could be there could be a transfer of shares from non-resident to non-resident, right? Now, it is not that all types of transfer of shares or any asset from non-resident to non-resident are covered within the Article 13. You need to see whether the subject matter of transfer, its location, the right it gives, etc., etc., can be brought to tax within Article 13. Right? Again, there's a foreign company based out of Netherlands. It owns the shares of an Indian company. It transfers the shares of the Indian company to another foreign company, FCO 2. Now you must be wondering, if there is a transfer of shares of one Indian company from one foreign company to the other, why should that be taxable in India? The reason for that taxation is simple. The shares that are getting transferred are of an Indian company, and therefore it is assumed that the subject matter of transfer is in India, or the situs of the capital asset is in India, and it is taxable in India under the provision of the Income Tax Act. If there is a relevant clause of capital gain in a treaty, which I'm sure is there in almost all the treaties which India has, right? You can opt for the provision of the treaty to the extent they are more beneficial to you.